Welcome to the Global Investor Podcast, a show that focuses on helping foreign investors enter the lucrative U.S. real estate market. Host Charles Carillo combines decades of real estate investing experience with a professional background in international banking to interview experts in all areas of U.S. real estate investing. Now, here's your host, Charles Carillo.
Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carillo. Today we have Dave Van Horn. Dave has raised over $200 million for both notes and commercial real estate, and he owns a considerable portfolio of residential investment properties as well as various commercial holdings. His company, PPR Note Co, manages several funds that buy, sell, and hold residential mortgages nationwide. So thanks so much for being on the show, Dave.
Oh, my pleasure. How you doing, Charles?
So give us a little bit about your background, both personally and professionally, prior to getting involved in real estate investing.
Prior to real estate investing, well, when I got out of college, during college, I worked for a contractor, a painting contractor, and continued doing that. And then eventually became a small business owner myself as a contractor and a part-time real estate agent. And that's kind of how I morphed, into real estate. I really had no retirement. So some of the other realtors that were training me were like, their retirement were the houses they had, their rentals,
Mm-hmm. Interesting. So is there another reason why you chose real estate as your investment vehicle when you started out?
Yeah, because I got out of college and couldn't really get a job in my field, which is ironic. I was a business major and look at me today, right? I'm the CEO. It's kind of funny. My mom still says that to me, like, are you going to get a real job? Like I was telling her I was taking a course and she's like, oh, that's good. I hope you'll be able to get, you'll be able to be more like hireable, and I'm like, I don't know that I can. I'm already the CEO. So where do you want me to go? So you get, I'm probably a bad employee at this point, put it that way.
Oh yeah, I think all good entrepreneurs are bad employees. I would consider myself a bad employee. So let's break down kind of your firm as involved with a lot of notes and note funds. So after you guys have done 10,000 plus notes, and what's your firm's investment note criteria and strategy when you guys are give us a little background of kind of like how the process works and then how your fund works.
So in the beginning, we specialized in the junior lien space, and it was because it had a lower barrier to entry. And most of the time, unless they're high value junior liens, you're not as geographic centric. So you could, buy junior liens almost anywhere, but a lot of times, then we, grew in size and we morphed into more first mortgages. And today we do a lot of commercial mortgages, that kind of thing. A lot of it does revolve around population centers, where there's people. We tend to do better than, like, say, in rural areas, things like that. But most of what we buy today is through our JV partners, where we buy, massive quantities, and then they run actual trade desks. So today, it's not that you would not do business in any given state. You may limit your concentrations in particular states, or based on, we have like legal timelines and cost matrices. So but a lot of assets are discounted if they're in a less desirable location too, right? So you got to factor all of that in. So I have a partner that says that sometimes there's no bad note, just bad pricing, right? So it's, so they build those discounts in, like into less favorable states or more litigious states or states that have longer foreclosure timelines. Those assets trade at different amounts,
Interesting. So when where are you sourcing your notes from? And is it right now, are you really doing junior liens or is it really senior?
Actually, we do other than legacy asset portfolios, we don't do a lot of junior liens at all. It's mostly all first mortgages and commercial loans. And a lot of what, we do some reverse mortgages like HECM loans from HUD. Mm-hmm. Most of our assets, other than those from some GSEs, government agencies, most of them are through trade desks, all institutional. Like we don't do any, contract for deed type stuff or, seller finance notes. We really don't do that. We're really in, institutional originated mortgages, Mostly
Okay.
1 to 4 family is a big piece of it. But then we do short-term business loans, which are hard money loans. We also do commercial construction loans. So we don't necessarily originate them, but our partners do. So today we outsource more than we did in the beginning. In the beginning, we were asset managers. Today we're more of capital allocators, so to speak, with good operators. Okay. Yeah.
Interesting. So is there a certain criteria or strategy when you're looking at, say, the majority of your debts are going to be first position, 1 to 4 units, so residential properties. So is there something other than using your how you had it before for your strategy for every state? Obviously, if it's more litigious or if it's harder to work in, there's going to be a different amount that your formula is going to come up with to pay. But other than that, is there are you looking for certain notes when you're sourcing them that are discounted because they're non-performing up to a certain amount, or kind of what's your sweet spot of what you're looking at when you're sourcing these?
I'm actually not part of acquisitions, but they do have criteria, and it's also market driven. So what happens in it, they're, how do I say this? Note values are a direct correlation to real estate values. So in an up real estate market, they're trading at a different margin than in a down market. Probably the biggest market condition is probably unemployment. If unemployment's high, this channel of our business does well. Whereas, a lot of our commercial stuff, we're tied into originators. So whereas in the non-performing loans, they're already existing, and we're buying stuff that's in default. So defaults tick up when unemployment's high, that kind of thing. And then we also invest, we're looking at areas like mortgage servicing rights, for example, where it's just a counter-cyclical way to invest in the business where, like, say, interest rates go up, mortgage servicing rights could become more valuable in those cases. So there's different channels within a channel that we can diversify into to, spread some risk around.
Interesting.
Yeah, get a better risk-adjusted return.
Dave, what is your role at your company?
Well, I'm president and CEO, and my primary role, especially up until recently, was always on the capital side, capital raising side.
Okay.
Marketing, things like that. I would oversee them. But I also do oversee our REO department, which is real estate owned.
Okay.
And it's because I have a strong real estate background, and we have an REO agent that dispositions hundreds of homes a year, that kind of thing. And they're sprinkled throughout the country. Interesting.
So with what we're seeing now with what's going on with COVID, how has that changed? I mean, kind of we're on, I would say, the downswing of that. But how did that affect your business over the last in 2020 and early 2021?
Well, it was, it's interesting. At first, it was hard to tell what was going to happen. But I guess the biggest impact was moratoriums, right? Because it's clogged up the courthouses, right? So we're just starting to come out of that. I just got a report today. It's about 60% roughly, is functioning again, where you can get through the courthouse systems. So you're going to see a bunch of pent up demand, basically a clogged toilet of foreclosures trying to get through. So we anticipate it's going to take a little bit longer. Prior to, like, when we were completely shut down, we were actually shifting a lot of strategies, shifting things around. There was different pricing based on that. For example, we were doing deed in lieu strategies, things like that, where we were trying to, I don't say circumvent the courthouse, but in a way that's what it was.
Yeah.
So it did limit revenue, for example, in certain buckets of, certain revenue sectors of the company would be, impacted by the moratoriums. But the good news is it is asset backed. And right now you're seeing real estate values are still pretty high and people are still looking for deals. It's still a seller's market. So we're getting really good execution on what we do sell. We're actually selling stuff much higher than we thought. A lot of stuff that's going to the foreclosure sale, we're putting it full, what we're owed, full bid, like, because if it comes back, we make more is really what happens, So,
right.
Yeah. We're actually hoping stuff doesn't sell at sale. I know that sounds bizarre.
No, that's what happens in
most
a
cases.
market like this. It's crazy.
Case, but most cases, you're hoping that it doesn't sell at sale. You'll have better execution when it comes back,
So the strategy with you guys is you're finding notes most likely non-performing. You're trying to turn them to performing and then sell them. Is that kind of how it goes?
It is if they're occupied. If they're
Right.
vacant, it's just you're buying property. Really, it's just one extra step. You got to clear the title if it's vacant.
Yeah.
So, like when we buy a lot, for example, I mentioned reverse mortgages. When we buy reverse mortgages, they're usually all vacant and deceased borrowers. So we're really buying property.
Okay, interesting. I was looking on your website when doing research, and it's you guys are pretty much in every state. Is there? I mean, it was crazy. I was looking for states that you weren't in, but you're everywhere, really heavily in. I think was it New York, Florida, and California. Obviously, those are biggest states. But is there states that you like? I mean, what are the states that really know people are looking for, where it's a little easier for you to, where you could pay higher for, I guess, or there's less chance of getting the hassle with going through so much with courts, and the foreclosure process isn't as difficult, I guess.
Yeah, I mean, the old rule of thumb would be, deed of trust states instead of judicial states. States like Texas and Georgia were quick states, but those assets trade higher, right? So, so they factor that in, or there's not as many available, right? Because they get gobbled up. Like Texas is probably, the number one state for some of that. Where it could be, lender friendly or just like landlord friendly states, so they exist. But I think a lot of it has to do with what's available in the marketplace at any given time. So we don't necessarily, we can only buy what's available too, right? So, and then some states just don't have a lot of assets. So if I was in Wyoming, there's not a lot of Wyoming loans. There's not a lot of Vermont loans. They're just because they're just, small states or not a lot of population, so some of that's a function of that. And then some of it is directly correlated to how much distress they had in an area or how long their foreclosure timelines are, like New Jersey or New York, or, they tend to be longer timelines. There are some things you can do to accelerate some of that stuff too. And that's where, having a good legal team is helpful. Also compliance. You want to, be dialed into the compliance of a particular state, what licenses are required, those types of things. And that becomes a whole nother matrix.
Yeah. So you're sourcing a lot of these loans from originators, and what's your exit strategy? Where are you selling these? What's the secondary market? Are they going to institutional people? Are they going to private investors? Are they going to private equity?
Yes, and yes. Some of them, we have a big portfolio. We've probably acquired, for example, in the last year, just in the one channel, about 68 million in assets. That portfolio will get securitized and sold off. So, and then we have other assets that we disposition ourselves, where a lot of it becomes REO property, especially if they're vacant, that kind of thing. And then we do modifications as well. And then once those modifications are seasoned, especially in this market, they go back to almost par. They're getting good execution right now. So it almost right now, it almost always pays us to hold the assets till they're performing with some history and then sell them and get better execution.
And it's usually like, what do you have to usually season them, or how long do they have to perform
like 12
for
months,
before the 12 months is okay? That's where
you don't have to. You could sell them earlier, but you're gonna catch a tailwind if you do that. So, and that's not always the case. It's a function of this market we're in right now. So, we started back in 2007, so we've been through multiple cycles, and you'll see, the way the market dictates things. You shift gears to get better execution.
Interesting. So we have a lot of listeners that are mostly on the equity side, and that's why I like bringing on different investors that are kind of making money in real estate and all different types of portions of it. So why would you feel that note investing is superior to the traditional, I guess, real estate investing strategies that you might hear, multifamily, all this other stuff, where it's a lot more active, I would say, or semi-passive if set up correctly?
Yeah, you're not gonna like my answer. I don't know that I think it's superior. I just think it's different in how it's scalable, since it's a paper asset still backed by real estate. And I do all the other things you mentioned. So So I do multifamily and I do, regular real estate and I do, so it's not a case where I think, one's better than another or anything. They're just different. And, I believe everybody should have some, section of paper assets in their portfolio, just like you should have some real estate or multifamily or,
Yeah.
commercial real estate. So I kind of have a lot of that, different types of holdings. I just happen to have a business in it, and it's very scalable, and it can be passive if you outsource certain things. So for me, it was kind of figuring out, if you figure out what your strengths are, you can outsource the rest, and hopefully that serves you well.
Yeah, for sure. I like the diversification portion of it. Can you give us like how the fund works in a sense of how your usually timeframes work on it? Because obviously if you're passively investing, or not obviously, but passively investing in other kind of equity side of real estate investments, you're really 5, 7, 10 years. Can you kind of
Yes.
explain the process with how your note funds work? Because it's a little different, and how it's structured, and how someone who's never invested in a note fund, what they can expect.
Yeah, like our terms are shorter, and we have the ability to compound. We'll have like liquidity options where you can invest for 6 months, 1 year. Our longest term is usually 3 years, and you hit on it pretty good because I've done a lot of syndication over the years, probably 20 years, over 20 years now. And a lot of syndications could be 3, 5, 7, 10 years long, especially in larger commercial projects, things like that. So we kind of fit in a different niche, right? Just like there's some short-term business loan funds or hard money funds that are, maybe a year in length, or, short-term as well. So I think there's a place for all of this where, as an investor myself and running investor groups too, investors like short-term, long-term, mid-term type of capital. Sometimes you marry the investment to tax strategies, or, it's which master are you serving? I like to marry my money or type of money to the type of investment. You see a lot of that. And then some people like the ability to compound, or, just to diversify into another, asset-backed investment vehicle.
Interesting. So the one thing was, when we have people that are investing in our syndications passively, and they might have a self-directed IRA of some sort. And one thing that's kind of a drawback, I guess you would say, is because they have the unrelated business taxable income, the UBTI. Is that something that now, because there's not the best tax benefits when note investing, let's say, because it comes out as ordinary income, is with the UBTI, is that something that you can kind of avoid now because you're not actually buying the property with debt on it? Or I've heard people go both ways on this, because there is debt involved. You're just on the other side of it. But
so most of what we see is the UBIT usually applies for investors investing in a note fund that utilizes leverage, but not when you're buying a note. Because when you're buying a note, it's interest income or a capital gain, when you exit the note. So it's really, does that fund utilize leverage? And that's where the UBIT kind of sneaks in a note fund. And some note funds do, and some note funds don't. And that's why I think it's, I don't say confusing, but it can be. And it's just something that is there, and you just got to be aware of. I mean, it's, a lot of times you'll see people put regular capital in as if there's it depends how big UBIT's impacting you, and whether you can offset it with something.
Yeah. Interesting. Yeah, of course. I don't want to put you on the spot there, but if anybody, just speak to your accountant about that. But it's just something interesting in keeping.
I'm not a CPA
it's something
or attorney, nor do I want to be one. So
neither of us are. So it's just something that when you're passively investing, what you're doing with your self-directed IRA, should be something that you keep that as, because it will offset or change your returns. Yeah. What are common mistakes you see note investors make?
Maybe not doing enough due diligence on a note seller, for example, or maybe not having their end game in mind, or, I guess one of the first decisions is, how active or passive are you going to be? Do you want to go buy a couple notes and collect cash flow, or do you want to run an active note business like mine, right? So they're completely different things, where one has employees and all the good old trappings that go along with that stuff. Or do you want I just want cash flow from an investment and I'm pretty passive, those types of things. And I mentioned it earlier, like staying up to date on the compliance and the legal aspects of the industry, and knowing where those pitfalls could be, that kind of thing.
Interesting. Okay. What do you think are the main factors that have contributed to your success over 30 years in real estate, both equity and debt side?
Probably maybe time, persistence, networking for sure, because we have a big investor audience and investor base, and one of our fortes is raising capital. So that's one of our core competencies, one of our big strengths.
In the commercial real estate, just off top here, so like in the commercial real estate, it's a very small market kind of industry, I guess, when you're talking, especially within, like, let's just say multifamily. Is it with notes too, where it's very people know the other funds? And I heard before someone was saying that if it's you get into a bad relationship with a note seller or something like this, and that person's like, they'll blacklist that guy from or person or business from buying it. Is that
it can happen with funding, especially.
Okay.
A lot of times we have to close quicker maybe than multifamily. Sometimes,
okay.
I watch my acquisition team. Sometimes they do diligence in a couple of days and have to perform very quickly. But then sometimes they may have up to a month. Well, a month could be shorter than multifamily, which might be, it's called 60 or 90 days or something, where you have, so that to us, that's like, oh man, that's all the time in the world. That's a lot of extra time, right? But especially if they're looking at a lot of assets, I've seen them look at thousands of assets and have to do their diligence on thousands of assets instead of one asset. But, sometimes one asset could have a couple hundred units, right? So it's not like you're not doing anything, but
right.
Yeah, I mean, you see it though.
Interesting. So how can our listeners learn more about you and your business, Dave?
Probably the easiest way is our website, PPRNoteCo.com. I do have a distressed mortgages group on LinkedIn, and I'm on Bigger Pockets a lot, answering questions and stuff like that. People are trying to do the note business. But yeah, you can go to our website, reach out to us, set up a call with one of our investor relations persons,
Okay. So I really appreciate it, Dave. I will put the links to your firm into the show notes. And I want to thank you so much for coming on today, and looking forward to connecting with you in the future.
My pleasure, Charles. Good luck with everything. Take care.
Talk to you soon.
Hi guys, it's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Thank you for listening to the Global Investor Podcast. If you like the show, be sure to subscribe on iTunes or Google Play to get new weekly episodes. For more resources and to receive our newsletter, please visit globalinvestorpodcast.com. And don't forget to join us next week for another episode.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.